Okay, welcome to our next video on fiscal and monetary policy. Today's essential lesson question is how are fiscal and monetary policy tools used to attempt to achieve macroeconomic goals? And remember, those macroeconomic goals include things like economic growth, stable prices, and full employment. So let's first recap a couple key issues. First is unemployment, inflation, and GDP as slash the business cycle. We learned these things already, but recall that GDP and inflation typically have a positive relationship. As GDP increases, inflation typically will increase. As opposed to the unemployment rate. The unemployment rate typically moves in the opposite direction. As GDP and inflation are increasing, the unemployment rate tends to decrease. Now again, this isn't always the case, but historically speaking, this tends to be the trend. And also recall that this can make fighting these things or trying to achieve these economic goals a bit tricky, because when you start to solve high inflation, it might lead to, or the actions might lead to, higher unemployment. Okay, one of the ways in which the government can take action to try to manipulate GDP, inflation, and unemployment is using fiscal policy, which are two tools that are used by the United States President and the United States Congress in order to adjust or impact, the real domestic output in the country by changing, aggregate supply or aggregate demand. And these two tools, of course, are taxes and spending, the two things that the President and the United States Congress can control. Now, because nobody likes to pay higher taxes, and the fact that some people feel real pain when the government spends less money, it's more popular for politicians to want to cut taxes and increase their spending, which, of course, and certainly we've seen this throughout history, but certainly in recent history, we've seen higher deficits and more national debt. So certainly there can be some real drawbacks to trying to solve economic problems or reach our economic goals through using fiscal policy. Okay, to summarize fiscal policy then, the two tools, government spending and taxation, can be used in a couple different ways. First would be if there's a recession, which means our economic growth is stagnant and high unemployment. So that would lead to increases in government spending and or decreases in taxation, and this is called expansionary policy. But as we already mentioned, the drawback here is increased federal budget deficits and national debt. But what it's trying to do is to stimulate spending on the consumption side or the consumer side, as well as the government taking its own action into increasing spending out in the economy and boosting economic production. Okay, now these same two tools can also be used in the opposite manner, and that is to fight high inflation. And so government spending, of course, would decrease and taxation could also increase. Now this is called contractionary policy because it's trying to slow down economic growth, which is often correlated to high inflation rates. Okay, the use of fiscal policy is not without debate. There are those who believe more in Keynesian economics or demand-side economics, that fiscal policy should be targeted to increase demand. And in doing so, the government's job is to really prime that pump, quote unquote, to encourage more spending in the economy, whether it's on the consumption side by the consumer, say maybe by cutting taxes, or by the government itself. Now the Keynesian economics has been used in some cases with some minimal success in our history, but also has led to increases in government deficits and national debt. But it had a big impact on the policies of Franklin Roosevelt during the Great Depression, and certainly we saw it again in full force with President Obama's attempt to deal with the Great Recession back in 2008. So there are some who reject Keynesian economics and instead subscribe more to supply-side economics, where the idea is the key to economic growth is to stimulate the production side of things, not so much the demand side of things, the belief that supply will create its own demand. So the government's role then is to cut taxes that target more business investment spending, as well as to reduce government regulations. Critics of supply-side economics will typically argue that these policies favor the wealthy or favor the businesses at the expense of consumers. But this was the main approach of Ronald Reagan in the 1980s. And lastly, there are those who believe that the use of fiscal policies, the changing of taxes, tax rates, and spending levels only disrupts the economy. And so monetarists believe that the key to economic growth is really just providing a stable money supply, that government should regulate a steady, predictable increase in the money supply, which would lead to a steady increase in economic growth. And beyond that, just let the free market operate. And the mention of the money supply here is actually a good segue into the next topic of the video, which is monetary policy, another way in which the government may try to stabilize the economy and reach economic goals. So monetary policy are tools that are used by the Federal Reserve now instead of the President and Congress in order to really change the supply of money or the access to money and the access to credit, which is an important driver of economic activity in our economy. Now, to better understand monetary policy, it's helpful to understand what's called the fractional reserve banking system or banking cycle. And what this essentially means is that when you go into a bank to deposit some money, that money just doesn't sit there in your account. The bank will take that money and lend it to other people because that's how banks make their money, by charging interest to those who borrow money. So as illustrated here, the first person walks into a bank and deposits $1,000. Now the bank has to keep, let's say, $100 on reserve, but it can lend out the additional $900 to another person. And if that person then takes that $900 and deposits into another bank, that second bank can then repeat the process. And so this $1,000 can steadily grow to a much larger number throughout the banking system. So whether the Fed wants to encourage more of this borrowing and lending to encourage more economic activity, or if it wants to discourage lending and borrowing to slow down economic growth, it can use monetary policy. Okay, the Federal Reserve System is really the nation's central bank, created all the way back in 1913. And really the overall purpose of the Fed is to carry out what's called monetary policy, including three tools that you'll have to know and we'll discuss in a minute. And these three tools are used to try to stabilize the economy, really by ensuring that borrowers and lenders have an appropriate amount of access to money and credit. And more specifically, the Federal Reserve is really an independent body within the federal government. It's part of the government, but it makes decisions independent of the executive and legislative branches. And this was done on purpose. This would help to minimize politics when making important decisions about the money supply and interest rates. So, for example, a president can't take action by himself to cut interest rates so that people borrow and spend more right before an election to make him or her look better. While the structure of the Fed is shaped like a pyramid, it's really just important to know that the top of that pyramid, which is the Board of Governors, there are 7 members that are appointed by the President and confirmed by the Senate. The one that you hear most often about, of course, is the chairman or chairwoman of the Fed. Currently, that's Janet Yellen, the first woman to hold that position, and she was appointed by President Obama and approved by the Senate back in February of 2014. Whenever Janet Yellen speaks, everyone's listening because she's revealing what the Fed is likely to do or is going to do with interest rates and in the money supply, because that really impacts everything. It impacts all economic activity. So when Janet Yellen speaks, everyone listens. Okay, the country is then split up into 12 districts, and each district has a Federal Reserve Bank, and this is the operating arm of the Federal Reserve. So when the Fed makes a decision about interest rates or the money supply, it is implemented through these 12 Federal Reserve Banks themselves. And one more part of the Fed worth mentioning here is the Federal Open Market Committee, or the FOMC, which does consist of the Board of Governors. But what they essentially do is they conduct open market operations, which is one of the 3 tools of monetary policy that we're going to learn here in just a minute. Okay, similar to fiscal policy, the Fed can engage in what's called expansionary or contractionary policy. Okay, expansionary policy is any action taken by the Fed that aims to increase the money supply and spending, or to encourage more economic activity, also known as an easy money policy. Contrastly, they can also engage in contractionary policy, which is an action taken to try to decrease the money supply and spending, and so to decrease economic activity. And this is also known as a tight money policy. Okay, so here are the three tools of monetary policy. The first is the reserve requirement. This is the percentage of bank deposits that must be kept on reserve within the bank. So in other words, if you go deposit $100 into your bank account and a bank has a 10% reserve requirement, they have to keep $10 of that money in its reserves, and it can lend out the other 90. So raising this requirement means there's less money to lend out and less economic activity. So again, if the current reserve ratio is 10%, but the Fed were to increase that to 20%, now they have to hold on to 20 of your dollars instead of 10. So now they have less money to lend out. Okay, now lowering the reserve requirement would mean that there's more money to lend in, which would possibly increase the level of economic activity. So if the current reserve ratio is 10% and the bank had to keep $10 of your 100, by lowering it to 5%, now they only have to hold on to 5 in their reserves and can lend out the other 95. Now, while this tool isn't used that often, it is an important tool that is a possibility for the Fed to use to increase or decrease economic activity. Okay, the second tool to be familiar with is called the discount rate. And now the discount rate is the interest rate that the Fed charges banks for short-term loans. So in other words, if a bank, think of a bank that you would go to deposit your paycheck, if that bank runs low on funds, it can borrow money from the Fed so that it can meet its reserve requirements, or if it wants to lend out more money, it can borrow money from the Fed itself. Okay, now an interest rate is the charge to borrow money. So if the Fed raises the discount rate, this would discourage the bank from lending more money out. So that would lead to fewer loans and less economic activity because it's making the charge to borrow money higher. And conversely, lowering the discount rate would make it cheaper for banks to borrow money from the Fed. So this would encourage them to lend more out. This would lead to more loans and more economic activity. The key here is to think about an interest rate as really the price to borrow money, or the charge to borrow money. If you needed to borrow money from a friend and your friend charges an interest rate, that would mean that you have to pay back $100 that you borrowed plus an additional $100, you're likely to be discouraged to borrow that money in the first place. So the same thing is happening here. If banks need some more money to meet their reserve requirements or to lend out more money, they're going to have to pay a fee to do that. So by raising the fee or raising the rate, banks will be discouraged from lending more money. Lowering the rate will encourage them to lend more. Okay, the third tool is open market operations, and this is conducted by that Federal Open Market Committee that I referenced a little bit ago in the video. Now, this is the most common tool that the Fed will use to try to regulate the supply of money to discourage or encourage economic activity. Basically, what it's doing here is the Fed is buying or selling securities or treasury bonds. Now, we know the federal government borrows a lot of money, and how it borrows money is through issuing bonds. So basically, a bond is a place where you can park some money. So the Fed can either buy some bonds, or it can also sell some bonds to try to regulate the supply of money and interest rates in the economy. Okay, to simplify this, I want you to think of it this way. If I sell you something, I'm going to take some money away from you. Okay, if I buy something from you, I'm going to be giving you money. And in this case, you are the banks. So if the Fed were to buy securities from the banks, the Fed is giving the banks more money that they can eventually go out and lend. If the Fed is selling the securities to the banks, it's taking money away from the banks, which means less money that they can lend out. Okay, so a quick recap here. If you think of a bond as a place in which money can be kind of parked to invest money, to earn some interest off that money, and you envision that, say, banks are currently holding some of their money into government bonds, the Fed can buy those bonds from the bank, which infuses more cash into the system that the banks can lend and create economic activity. Now, if the Fed is holding on to government bonds or government securities, it can entice the banks to want to buy them, so which means the Fed would sell them to the bank. The bank would then hand over some of its cash or reserves to the Federal Reserve in exchange for holding on to the bonds. What the Fed has done is has taken money out of the system, which means less money for the banks to lend, which would slow down economic activity. Okay, so buying securities increases the money supply, selling securities decreases the money supply, which again would encourage or discourage economic activity. Okay, one last slide here. A term that you may come across is the federal funds rate. And the federal funds rate is the interest rate that banks can charge one another to use excess reserves. In other words, if a bank wants to get access to more money because they need to meet the reserve requirement or they want to lend more money, they can borrow money from another bank instead of the Fed. And so the Fed tries to set a target for this rate, okay, the federal funds rate. And since 2008, since the Great Recession, the target for this rate has been 0% because of the sluggish economy and because the recovery from this big recession has been somewhat slow. And the big news on December 16th of 2015 was that the Fed finally raised the target federal funds rate to by 0.25% from 0%, so to 0.25%. And that was big news because it shows that the Fed is a little bit more optimistic about economic growth in the economy. And so now that it's set this target federal funds rate, it's going to use monetary policy to manipulate the money supply to get the interest rate closer to that target rate of 0.25% as opposed to 0%. Okay, you've reached the end. So fiscal and monetary policy can be some pretty confusing concepts when you first learn them. So hopefully this gave you just some of the basics that we're going to use to get a little bit more in depth with this in class. Make sure you take care of any other obligations, and I will see you next time.